Hello, I'm Greg Bonnell. Welcome to Market Call tonight. Our guest is Jaime Carrasco, portfolio manager at Canaccord Genuity. Wants to take your calls, your emails, and your tweets on precious metals, pipelines, utilities, REITs, and dividend-paying stocks. So give us a call. It's toll-free, 1-855-326-6266. You can send an email to marketcall@bnnbloomberg.ca, or you can tweet us at Market Call. Good to see you again, Jaime. Always good to have you here.
Thank you for having me back. How have you been?
Not too bad. These have been exciting times. You know, we were talking just before we went on air. You continue to advise extreme caution in this market.
Right. It's funny. I was over the weekend. I picked up James Rickards' book, When Currency Dies, which is a pretty good. He was talking about crisis theory, and I realized, he's wrong. I think if we're going to look at how things are setting up, a chess game is the best way to really describe it, because with chess, the moves get smaller and smaller into a final outcome. I think if we look at the way I see the way that things are shaping up, it's more like a chess game, because what we are witnessing is a monetary shift. If you look at Trump is really well saying America first. We have to get rid of the system that has been that we've had in place. It's not working. What he's talking about is the currency reserve, the fact that the U.S. has to continue to borrow money. Well, we can't borrow anymore. And I think if you look at how the pieces are positioning themselves, the geopolitics, the politics with Europe, everybody's starting to go away. So the 30s is a great period of time to find parallels into what's going on, because that's the last time we went through a similar setup. Now, the reason why I wanted to come on as close as possible to the U.S. election is because the U.S. election, I think, will be very important, because it's going to, in my opinion, until the events of last week, of course, which were pretty sad. But until then, I think the Republicans are really going to consolidate power, because Americans don't fully understand what's going on, but they listen to the rhetoric. America's great.
So you think the Republicans are going to sweep next Tuesday?
I thought until before last week, the Republicans were definitely, if you look at the early polls, everything that allowed me to see Trump winning in the last time around, it's playing out again. The number of people looking at YouTube, his rallies are huge, right? And they're happening throughout the country. So yes, I did think that the Republicans would win, and that positions it this power shift from the point that it will consolidate its power. Right, and part of what he wants to do is break up everything. He's already saying to the Chinese are the next big evil that they're trying to go after with the terrorists. But what they're really saying, hey, time that everybody goes on their own. And the Chinese, if you look at what they're doing with Iran, or with the petro yuan, everything that's being set up is new systems to be set up. And I think the king in this chess game, the queen might be the monetary system, but the king is gold, because gold is the ultimate form of money when currencies stop working, when we lose trust of whoever's on the other side of that debt. And I think what Trump is saying, well, yeah, we can just print money. We're going to devalue our currency. And that's really what he needs to make America great. So I'm looking at that puzzle in terms of what's happening right now. Interest rates, look at 2 weeks ago, last time I was on, I was talking about rising interest rates, and Gunlash was right. As soon as we went over 320, it created all that volatility in the market. Well, interest rates have to go higher. We have to resolve the debt. How do we do all this? I think when it's all said and done after the election, we will have a much greater direction. Look at Merkel now. Merkel's out. So Europe is up in the air.
Basically saying, I'm not going to go for it again. So even though she has a few years left in her term, who knows how those politics play out?
Well, it creates a void, right? It creates a power vacuum, especially now that Italy's really asking for more out of the Europeans. And what did the Europeans say? Well, we don't accept the 2% deficit. What did they say? Hey, we got Rome. Let's go.
Now, you did compare this environment to the 1930s. It wasn't a great time for stocks. It wasn't a great time for the economies of the Western world. Do you see those parallels carrying in?
I do think so, because to me, we are in a credit cycle. The reason why the markets have gone up so far has nothing to do with economic activity. It's all money that's being printed. If you actually follow the trends, it all began to change sometimes around the year 2000. You had the internet bubble, the housing bubble, and now we have this bubble everything. Everything's gone up except gold, which, I think the way I see it is with all the money that's being printed, and by the way, the other reason we're seeing the volatility is because the Fed's starting to pull that money that has been printed out of the system, and that's going to continue. Powell wants to continue. So if you look at the way that it's retrenching, it's all of these assets that have applied coming to the market have pushed markets up and kept one down. And I think when it's all said and done, those mechanics won't be able to work, and we're going to get the reversal. And that's why I'm positioning myself more looking at how all of this unwinds, using history as a guide. And I do think that when you talk with most of the credit analysts, the credit guys, Gunlash, the guys that look at that, interest rate observer, James Grant, what they're calling for is be careful because of the debts, and it's the debts that's the real elephant in the room. The entitlements, look at all the noise that's coming out with U.S. pension funds, which are very much underfunded right now. Now, how is that going to be affected? The only thing holding them up is the stock market. That's been a bit of a facade. So yeah, I think investors have to be more cautious, understand what's happening, and set up properly on how it happens, because it'll be a transfer of wealth, in my opinion.
I got an email from my old employer today about the pension plan, and the word distressed was in the topic line. That's what you'd love to see. I guess we're going to keep on working. Back with Jaime Carrasco. He's portfolio manager at Canaccord Genuity. He wants to answer your questions about precious metals, pipelines, utilities, REITs, and dividend-paying stocks. An email from Mike in St. Catharines, Ontario. Wants to talk Iamgold. Can I get your opinion on that name?
Yamana. Yamana is one of those that I do not own it, but it keeps pulling me back in. I keep looking at it. I like. Again, I haven't been making too many changes to the precious metals portfolio. I'm holding my positions, and when I set off on this road of advising that people hold some precious metals, my take was, okay, let's work with companies with good management, good low cost of production. Good reserves on the ground and in geopolitical correct areas. Now, Yamana fits most of those. The only reason why I didn't grab it is because at the time they weren't generating free cash flow, but we're getting to that point. Our analyst just pointed out we have it as a buy with a 475 target, and one of the things we do like it is that we're getting to the point of free cash flow. So if anybody does have it out there and they're considering what to do with it, I think averaging down or buying a little bit here would make a lot of sense. Everything I read about it is quite impressive. They've definitely have done a great job at putting everything together. And it looks as though it's one of those companies that has nicely made it through the tunnel that we've been going through. And I think at some point, these companies are just going to shine because we are going to have a problem in terms of sourcing out physical gold. Again, if you look at the way that I'm positioning this, go back to the 30s, the best beneficiary of that period were the gold companies, because all of a sudden everybody needed gold at a much higher price and the producers were producing it low. And that's why I think having a selection of producers is the best way to go. Yamana, definitely, we have it. I don't have it. I don't own it in the portfolio, but we do like it. I really like our gold team, and these guys have been dead on a lot of these companies. So yes, it's one that I would recommend.
Recommendation for Yamana. We have Roy in Burlington. What's your question, Roy?
Good evening, gentlemen. Jamie, would you be so kind as to give me your expert opinion on New Gold, please? Thank you so much.
New Gold. Let's take a look.
We have it as a hold, actually. It's not one that I own, again, but it's one that we follow. And internally, we have it as a hold. We were a little bit concerned with their Q3 results. So it was a bit of guidance was maintained, but the results were a little mixed. I do not own New Gold. I preferred others, and this one is one that I would tend to stay away a bit, or maybe consider doing some switches into something else.
All right, so not a recommendation for New Gold. The street has 1 buy, 10 holds, and 4 sells on New Gold.
Having said that, if you've owned it for a while and you're attached to the company, it looks as though it's one that at some point might come around. I have a company that Detour within the portfolio that's kind of in that boat, where it's a low-cost producer. The mine is up and running, and it looks as though at some point they're going to come around. I was quite happy to hear that Paulson also owns it, James Paulson, with the whole issue with revamping the management. So I wouldn't be that negative on it, but definitely if you're attached to it for some reason, holding on to it in the hope of a reversal, it might have quite a bit of leverage as well by the looks of it.
We have Mike in Huntsville. What's your question, Mike?
Thank you, gentlemen. My question is on Vermillion Energy. The last week or two, it seems to be on a downhill trend price-wise. in spite of its good dividend, and I would like your guest opinion. Thank you very much.
All right, let's take a look at Vermillion.
Okay, Vermillion is one of those companies that I have had in the portfolio for quite a while now. Let's talk about it in a different light, though, because right now I'm within the portfolio, the equity income portfolio that I manage, I like to overweight or underweight certain sectors. In energy, I've been sitting on an underweight for quite a while. And that underweight within the companies that I do own, I like to own the foreign companies because I don't want to. I see Canadian oil in a way stuck right now because we don't have the pipelines to sell it. So if you look at what's happening with the oil patch, we're having to sell our oil to the U.S. at a discount.
Huge discount. This is what confounds me about this name, though. Does the street not understand that they have the global exposure?
That's where I was going to go. That's where I was going to go.
They get dragged down with everybody else.
Exactly, right? And that's what I was going to point out. But be aware of the overall picture for energy, why I'm underweight Canadian companies, because of that differential. Having said that, Vermillion is a foreign company. So they're mostly in Europe, and they're getting Brent. Yes.
Yeah, because it's France and Netherlands, so they're getting Brent
and the
prices,
Netherlands,
right?
so they're getting Brent prices, and that's why I like it. That's why I have it in the portfolio.
But if the market doesn't reward them for that, I mean, it's because I hear that from people. That's a smart play.
It also means the dividend is safe.
And the dividend's 8%. Yeah.
And the dividend's 8%, which is why I'm holding on to certain energy companies, because of the dividend. It's part of my cash flow strategy, right? But I don't want to hold it in Canada because I'm not sure when we're going to have energy prices really skyrocket or moving higher. Now, I think it's also pulling back because oil prices have pulled back from the 74 range they got about 3 weeks ago, 72.
Back into the
and
60s,
they're at
68 around.
in the mid 60s. So they're pulling back. So I think with everything, you have to, first of all, get used to uncomfortable with volatility, which is what we're seeing. On the other side, understand the fundamental reason why you're going to own it. In this case, I am holding on to a little bit of Vermillion only for the cash flow, but I am underweight both the sector and Canada in that. And there I've raised quite a bit of cash. And actually, it's funny because I've been buying a little bit of Alta gas because the yield got over 10%. So I'm not fully escaping from Canadian energy base. Alta gas is Alberta. It's more distribution. It's more energy. But if the yields, what I'm expecting now is as this market begins to turn, that yields will increase. And so start to pick away at the good quality cash flow companies and add cash flow, right? Most people right now are sitting fully invested. I'm sitting in about 30, maybe close to 40% cash or liquid assets. And we're able to add more cash flow as the dividends start to pick up. And I think if the market does get hit going forward, all of the companies that pay dividends, we should be able to pick up much greater dividends going forward. And last time I was here, which was a couple of months ago, that's what I had said, that I was raising cash already.
Interesting stuff. Jerry calling in from Vancouver. What's your question, Jerry?
Good evening, both of you. Jaime, can you give me your view on Enbridge in terms of going ahead with buying Enbridge at this time, or would you stay away from these pipelines? Particularly, Enbridge is offering a pretty good dividend, around 6-7%, yet it's still in the doldrums too, which I don't understand what's happening with it as well. Or would you go with another pipeline rather than this one? Thanks very much. And Greg, can you give us a street consensus on Enbridge, please?
All right, Enbridge. Sure thing, Jerry.
Thank you.
We have both of these, Enbridge and Interpipeline, as a buy right now at our shop. Hold on, let me confirm. Yes, we have them both as a buy. And I like the pipelines. Pipelines are monopolies, right? But again, what I'm waiting to see, I like them all for the dividend. Mm-hmm. But part of the answer to his question is what is happening right now. I think what's happening right now is that after the last few weeks that we've had, we are starting to see pension funds start to get nervous and start to raise cash. And that's definitely showing in the dividend yields of a lot of these companies because they're the biggest buyers of these. And because of that, my strategy of waiting in cash is paying out. It's playing out. Enbridge, just like in 2008, if I recall correctly, in 2008, Enbridge began the year with about a 3.5% dividend. By the end of the year, I was getting about 8% at the end of 2008, by December of 2008. I think we're going to go through a similar period because when the selling needs to occur, institutions know that these are very liquid assets, and so they sell first. right? And I think that's what's happening right now within the spectrum. So I'm letting them come down in price and acquire at some point. I still have Enbridge. I still have a little bit of interpipeline within the portfolio, but it's part of that very reduced portion, and I haven't started adding yet, but at some point I think I will, because Enbridge, these are monopolies. We're not building any. We need them. And yeah, the Americans are benefiting from them since they all go south, but they are massive cash flow payers, and I think the cash flow is, we're going to need energy. Another thing is everybody's talking very brightly about the fracking revolution that the U.S. is going through. I think that if we go through a credit cycle of the way that it should play out, we won't have the cheap money to continue to produce fracking oil out of the U.S., and that's when our oil really starts to come back, and the pipelines are going to be great. The only problem is they're going to pay whatever price they want to pay for it, because we can't sell it anyways. So again, it's catch-22 for Canada, but the pipeline should benefit greatly.
Enbridge has 13 buys, 7 holds, and 0 sells on the street. We have Stu in Port Alberni, BC. What's your question, Stu?
Oh, thanks a lot. Okay, yeah, I just wondered if your guest had any opinion on Pretium Resources. It's a gold producer on the BC coast. Thank you.
All right, Pretium, let's take a look.
And a very good producer. By the way, before we move on to Pretium, Vermillion, I just wanted to point out that at Canaccord, we do have it with a $55 target for that caller earlier.
So it'll be quite a bit of upside. Yeah.
Quite a bit of upside. So we are comfortable with the stock. Pretium, right now we have it as a speculative buy. Let me look at this a little bit better. It's not one I own very little for this, just for one client a couple of clients that can't buy their actuaries, so they can't buy everything. So that's why I picked it up, and it's one that I've always liked. I quite like it. I believe we do have it as a buy with a $17 target. Production came in sequentially lower, but cash balance continues to grow significantly. Now, when it comes to the production side of a lot of these companies, they're struggling because of the price, right? The fact that Pretium has made it this far, the project, they continue to build production, they continue to lower the cost. That's normal, right? So it's part of the
life cycle of all this?
Yes, the beginning pains of a mine, especially when the prices are lower. But this one is one of those that, again, I like because they have the reserves on the ground, and it should have quite a bit of leverage once the prices do move. So yeah, I think it requires just a little bit of patience on this, but the leverage and the patience will be well rewarded because of the leverage that a lot of these companies have to the price movement, and the fact that reserves on the ground aren't even being paid for anything right now. And that's really the key to a lot of these companies.
All right, that was Pretium, and the street has 8 buys, 2 holds, and 0 sells on the name. It's time for Past Picks. We're going to go back to August 14th of this year, so not that long ago at all. Iamgold taking quite a drubbing in that short time frame. What's going on there?
You know what? I think it's more systemic to what's happening to the sector as a whole right now with this recent downside in price. Their mine is coming along well. We think that the growth pipeline out of their Boto mine is going to do extremely well, and it's going to continue, which again, what you want is the fact that these companies are surviving, right? So when it comes to the price of a lot of these right now, it's about looking at them like financial insurance. Sooner or later, the premiums are going to go up, and you might as well own them now and just hold on to them. We have this with a 950 target. We're quite happy with quite comfortable with the way management is executing. The growth of production continues. The cost of production continues to remain under control at $753. I'm not sure if that's Canadian or U.S. I would imagine it's U.S. because it's more of a that project is more in Africa. It's one of the reasons why I don't own Iamgold. I like it. It's our favorite pick from our team. I don't own it only because I don't understand Africa. Most of the geopolitical checkmark is the Americas for me, and that's where I keep most of my considerations. But yeah, no, it's not. I think it's just volatility of the market. But right now, it's it's fickle, right? If you look at what's going on with gold, gold's getting nailed. But it's interesting, the commitment of trader report has completely shifted in that about 4 weeks ago, all of the commercials covered, and they've transferred all of their shorts to the hedge funds, which is the first time since about 2005 that that's happened, 2006, I think it was. So it's really repositioning the commercials to rising gold prices at some point. So I personally think that we are getting near the end of this thing, especially as the volatility starts with the market, with interest rates. One of the things that actually made me feel very comfortable was the fact that on those days when the market was coming down 500 points, everything was down. The bond market was down, the dollar was down, the stock market was down. There was only one safe haven, and that's what I've been saying that's going to happen when interest rates, they finally lose control of the cycle and this facade that they've created.
Barkerville Gold. Now, this is a very small exploration company, but it is bucking the trend. It's actually up 13% in the time frame.
Actually, it's been a lot higher if you look at the chart. I think it hit bottom a while, but it's well managed. Well, Cisco backs it quite nicely. I think eventually they might even take it over. What it is a play in BC, in the Golden Triangle, and they keep finding very high-grade gold. They're actually growing it, and they're also in production. Production was key for the companies that I've had for the last couple of years, and they're one of the ones that is definitely making it through.
5 analysts follow the name. All 5 say buy. The last one on the list, Dream Global REIT, down 5% in the time frame. What's happening with Dream?
You know what? Fundamentally, not much. I like Dream. It's one of my income plays. I own it within the equity income portfolio. My strategy behind this one is the fact that it's out of Europe. So I'm betting that as the Canadian dollar, as we get into this currency storm that I think is brewing and coming our way, having assets that generate cash flow from outside of Canada is going to be quite beneficial. I think right now, if you look at Europe and you look at everything's a mess. It's like, where, relatively speaking, are you going to be better off? I think the fact that most of the assets are in Germany will also save this or give me quite a bit of safety in the cash flow. And because of that, I think it's one that I will continue to hold within the portfolio. And if the yield goes higher at some point, it's one that I would definitely be adding with some of the cash I have.
Yeah, yields at 5.9% right now.
Right.
Not bad. All right, we're going to take another short break. Then I'm going to return. The number 1-855-326-6266. Give us a call. We have Ara in Montreal on the line. What's your question, Ara?
Thanks for taking my call. My question is on Franco Nevada. Everybody and his uncle talks of superlatives about Franco. The stock hit 110 in the last year and a half, and right now they're 25% down in the low 80s, 82, 83 region, and hardly they move. So I'm just, people tell me that there's nothing to do with the price of gold, but tell me, what's the reason? Is gold out of favor because of that, or the financial situation is having something to do with it? And the same thing with Cisco, Franco, they're just doing nothing at this, well, in the last year or so. Actually, Cisco is coming down more.
What do you think ails Franco? What do you think? Thanks, Ara. What do you think ails Franco?
Well, I think it's part of the same ailment, right? Right now, there's a massive disconnect in the true value of some of these companies versus where gold is at, still above 1,200, and gold's fighting here in the 1,220 to 1,230 range, but the market is also fighting in the 25,000 range, so it's a bit of the opposite of each other. Franco Nevada on its own, again, I'm not concerned about the price of these companies. You have to understand that what you're buying is insurance. Franco Nevada is one of the most solid ones that you can have because of the nature of this company. This I buy for all of my for my equity income portfolio that I have to have some precious metals. It's 20% in precious metals, and Franco Nevada is 1/5 of that position. Because again, it's a dividend payer, it's a streamer, it's one of the oldest streamers around, very solid, and it's not just gold, it's gold, oil, and a lot of other assets. So because of that, I do think of it as the most conservative of this sector. Again, that's a hard word to use with the volatility of the sector, but I think that anybody that's looking to enter this sector, I would highly recommend to consider Franco Nevada, and at this price, I think it's a gift. The other thing with Franco Nevada that I particularly like is that they have a formula for the dividend. So as the commodity prices increase, they're also going to increase the cash flow. Right now, it's paying about 1.5%, maybe close to 2%, I would imagine, with the pullback. But that's
1.5 on the hill.
1.5. So it's gonna continue to grow. It's one of the few precious metals companies with a dividend, and so because of that, I think it's a solid company. The fact that it's down right now, it's a benefit, and I would. Again, don't go crazy, don't go over allocating, but make sure that at the very least you have 10 to 20% of your investable assets in some solid precious metals as insurance, and this would be one of the ones that I would definitely recommend as part of that basket, as part of that quiver.
Jerry in Camrose, Alberta, what's your question?
Yes, could you have your guest discuss Capital Power, CPX?
Capital Power, let's take a look. Thank you, Jerry.
Capital Power is one of those companies that, again, it's one of the utilities. I don't have it in my portfolio, but I do look at it once in a while, and I like it. We have it as a buy with a $31 target. The stock has held up very nicely over the last while. Is that a pullback where we just see?
Yeah, we're down 5% today on Capital
Any
Power.
news come out?
Let me tell you, wraps. It was earnings. Was it? There's 700. Yeah, it was the 29th. The 29th. So. Yesterday.
Okay. Yeah. Our earnings estimates, again, it's one of those that I would be looking at this more in terms of how does it fit within the portfolio. The dividend is definitely there. It's one of those utilities that is going forward will continue to pay the dividend, but you want to also be careful that as investment firms, if we get into more volatile markets going forward, as I predict, all the stock prices are going to pull back. Everything's going to pull back. So it's a good time to either raise a bit of cash and wait to get better yields later. But it's one of those companies that is pretty solid. All of these utilities, we're not building any, no matter what. The Canadian winter's coming, so we're going to have to heat up our homes anyways. So cash flow should maintain. The other thing that I like about a lot of these companies is the fact that I see them as an inflation hedge, right? Whereby at some point, the inflation that's being unleashed because of the monetary policies we're going through are going to hit home. Well, a company like Capital Power is going to pass it on through to us, right? So the shareholders aren't the ones that lose, it's the end user of the power. And because of that, their earnings are always pretty solid in bad periods, bad inflationary periods. And I think that's also something that I would be looking at when owning these companies. Again, how do you position the portfolio? Just make sure you're not 100% invested right now. Raise some cash and prepare for maybe something worse.
This quarter was a beat on the top line, but a miss on the bottom line for Capital Power. Let's take a quick break.
Hold on, and the problem with that kind of scenario is that it forces the hands of the institutions that are saying, well, I'm going to wait for a little bit more or just pull some money off the table right now. And that's going to create better prices for people if you're patient and wait for them.
Patience. We'll be back with Jaime Carrasco, Portfolio Manager at Canaccord Genuity, to answer your questions about precious metals, pipelines, utilities, REITs, and dividend-paying stock. But wait, there's more. No, there's not. Call us toll-free, 1-855-326-6266. We have Doug in London, Ontario. What's your question, Doug?
My question is on Eldorado Gold. I was just wondering, it's probably 52-week low. And there seems to be a lot of negative press around it, from the mines themselves to their board members and their salaries and a whole bunch of other things. So I was just wondering if you could comment on that. Thank you.
All right, Eldorado, what do you think?
I'm not sure about the negativity because I don't follow this. I don't own this company, but we do follow it. We have it as a whole right now. The chart doesn't look just like all of the other ones, but there's...
pull back the headline I saw from yesterday, a troubling third quarter results.
Right. So it's one that actually just by the look of it, I would probably forego for now and come back to it later. I would switch to something that's definitely delivering them better financials right now. You know, it's funny, the last 4 years, 5 years has been a really good test for good quality management out there, right? So you can set up a nice portfolio with about 10 companies with solid management of companies that have made it through this period in an unbelievable way. You know, not many companies are growing or buying, but there are some that are out there. So it's a stock picker's world. Within that, I think I would forego this one and go seek something else with a little bit better sustainability at the bottom. You know, the reason to own this, if I was part of management, is only to make sure that I get the rebound on the price of the commodity at some point in the future. Right now, though, what my strategy is to make sure that I'm having money in the ones that have made it, are outperforming, even though the share prices aren't showing it right now. Like all of these companies, patience is the key. But there are some that are definitely doing extremely well right now, and I'd rather be sourcing those out instead of the ones that are having a couple of setbacks going forward.
Bob in Midland. What's your question, Bob?
I want to talk about REITs. Just recently this week, I actually moved in, bought a couple of more, Sienna Retirement, and an industrial REIT, Dreams Industrial. Now, my question, I'm going to try to frame it here. I think by most analysis, a 15% correction in a stock would be deemed as a correction by definition. Since January, there's been a lot of amazing REITs in Canada due to rising interest rates. Nothing to do with the TSX. They've corrected by 15 points. They're paying serious dividends. My question is the correction in REITs already happened? Because this is my crystal ball, and this is the comment that I'm asking you to come back to me on. I believe the Bank of Canada, regardless of why, has this movement of maybe 3 more interest rates over the next year. Who knows why? I also believe that there's maybe another 5% correction in the TSX.
All right, so basically have the REITs seen the worst of it in a rising rate environment?
Again, that's why I'm holding 30 to 40% cash. No, I don't think we've seen the worst of this yet. I think the bigger problem right now, and how I'm positioning myself, is to underweigh the sectors that I own that generate cash flow, have cash flow set aside, and expect worse. I do think that if you look at the interest rate cycle, they have to continue rising. They've been rising because the dollar has been getting hit, right? So the way I see the puzzle shaping up is what's happening at the monetary level. Now, that's important because everybody's looking at the Dow. Well, what happens is all of a sudden the US dollar, under which the Dow is priced in, devalues by 50%. Doesn't matter. The Dow could go to 50, but you've seen a monetary devaluation. The same thing is happening with all this. So how I'm positioning REITs right now is having more foreign REITs, so the cash flows coming in, protect from currency, and actually expect greater yields going forward. One of the issues, we have this as a buy, but I don't own industrial, only because the only REITs in Canada, when I look at REITs in Canada, I first look at the geography of where they're located. You know, if you look at Artis, which had a lot of BC and, Alberta base, Western, I've been avoiding it. But right now, I'll probably start looking at it again. One of the problems with this one is mostly in Ontario on an industrial base. Well, we don't really know what's going to happen to the industry here in Canada yet until we know what's going to happen with the U.S. and Mr. Trump, and that is all up in the air right now. So because of that, I'd rather underweigh this and maybe expect to pick it up a little bit later. Second, if I already own it, figure out the cash flow. You know, is the cash flow going to be sustained, and are they going to be able to maintain the dividends? I think with a lot of these, the interest rate cycle is just beginning to rise. So how will it affect them later? I don't know. I'd rather wait and see how it plays out from a conservative stand of sitting with cash. Industrial REIT, I like these guys. I like Sienna, the one that he mentioned, definitely, because that's more of a demographic pool. They've done a really good job with a lot of their properties. Used to be Dream Global, and I've had it almost since IPO, and they continue to hold it. But again, it's different mechanics of what's driving them. Where I do think that REITs are going to benefit are rental REITs, if we can have a rental-specific REIT in Canada. Now, there are some that own some rental properties, but I haven't found a 100% rental-specific because we have no rentals. Right? Look at what's happening here in Ontario.
Build them first before
we have to build them, correct, right? And so because of that, there's a couple of rentals in the U.S. that look pretty good. But again, I'm being very selective of how I choose, but keeping in mind I'm not 100% invested in it. And I think his observation that they have pulled back, I'm more concerned that they will continue to pull back right now before putting any more money in.
We have Noel in Sudbury. What's your question, Noel?
Thank you for taking my call. Love your show.
Thanks.
My question is about FTN, Financial 15 Split Corp, paying right now at 19% dividend, and it sort of makes me wonder about maybe some murky water about this company. Thank you very much.
Yeah, it's quite a payout.
I think it's a payout, but I would be more concerned about the payout. And the reason being is what's happening with the, I took this question because I wanted to point out what is happening within the banking sector as a whole. And if you compare, this is the index for both Canadian and U.S. financials. We're seeing quite a bit of a devaluation in value here. You know, it is a bit, again, a precursor to what I think is going to be worse times ahead. It always starts to show within the financials when the markets turn. I personally think the market has already turned. If you look at the Dow right now, it's trading below the 200-day moving average, and it looks as though 25,000 became resistance as of last week. It's also below the 50-day moving average. So I'm beginning to see things are turning, and part of that turning is coming from the financials because of rising interest rates. Not because everybody says, oh, they're going to be able to lend at higher rates and make more money. It's really the derivatives that's the problem. And key within that, I would also point out Deutsche Bank. Deutsche Bank's earnings were not very good, and it broke below €9 in Europe now. Now that's a problem because of their credit. They're the bank with the biggest credit derivative swap position in the world at 70 trillion. Everybody says, oh, they're counterpaired or whatever, but it doesn't matter. Didn't help with AIG. The problem is that they have a lot of exposure to Italy. They have a lot of exposure to Turkey. So they're at the center of the storm of the of Europe, and that's going to affect all of the banking sector, right? So again, I think within this one, I wouldn't be chasing the yield just yet. I would more worry about the underlying structures of the indexes under which they're participating, and that's why I took that question.
Stephen in Vancouver, you'll be our last call of the night. What do you got for us? Stephen in Vancouver, you there? All right, we got Caroline waiting on the line. Caroline in Burnaby, you'll be the last call of the night. What do you got for us?
Yeah, it's about Century Select Primary Metals, PME. I've held it since July 2011 at cost base of $11.20. Now, I think it's down to about $1.90. It pays a small dividend. Now, what's happening to this particular stock? Because it's doing so bad.
It is doing bad. But if you own it still, I would highly recommend you average down onto it. Reason being, this is one of the best closed-end funds of companies. If you look at it, it owns 30 of the best gold and silver companies as the underlying asset. It's not derivatives, straight stocks that you own. So it's the portfolio of those companies that's going to deliver the leverage. It is paying a nice dividend right now. You know, if that dividend gets cut for any reason, that's fine because of the leverage to the portfolio. I don't buy it for the dividend. I recommend it as a standalone one stock where you can get a really good selection of companies. A lot of the companies we've spoken today, they're in it. You have Eldorado, you have Argonaut, you have Agnico Eagle, which is my favorite. So there's a full selection of great companies within it. So if you've already held it, I would just buy it for the turnaround, average down a bit, and wait, because it's a well-managed portfolio. It's no longer Kevin McLean managing it, but I like the new guy whose name doesn't come to me right now, but I have sat down with him and reviewed it because it's one that I have. I actually have the other one. It's the PME and the MMP. There were two of them, but one has a different tax structure than the other. One is repayment of principal, so it's almost tax-free. But again, it's one that I would not dissuade people from owning. And if you've had it all this time, do average down on it.
We'll be back after a short break. Top picks are coming up next. It's time now for top picks. We got 3 minutes on the clock, 3 top picks. I'm going to let you do the math, Jaime, because you're the fund manager. First one on the list, Agnico.
Agnico has been one of my top picks for years, and it continues to be. If you look at the earnings release it just had, they beat and raised guidance. In this environment, this management team has done unbelievable, and they continue to develop a lot of their properties, and I think it's going to offer awesome leverage going forward. At this price, it's a gift. At $46 after the earnings release, things will only get better. So I think it's a really good buy right here.
Man, you are bold with this next one. On a day when this stock dropped 16% on its earnings, you are going with AltaGas.
Again, this is the first addition of dividend income that I've added from the cash that I released when it went over 10%. Didn't spend everything I want to buy in it, but I definitely started building a position, which is about a quarter of the size that I want to own long term. And I think I might be doing it again tomorrow because they're selling assets. Means that they're buffing up their balance sheet, which is the one concern that I would have for the dividend, right? To raise cash right now and sell assets, they're singing my song. So I'm sticking with them. I think they're doing the right thing. It is Alberta-based. It's the only negative. But I think at this price, it's a good entry. We still have it as we do have it as a hold, right? So that's why I'm not fully buying it, but I am picking up cash flow. That's what I like about this company. And at a temp, what's the yield now? Must be 12%.
After today's price action, the yield is 13.15%.
Perfect. So I might go up to 40% of what I want to own in this company tomorrow, and I know that clients will be happy with the cash flow.
Bold play indeed. Final pick on the list is cash.
Again, I like to have my cash to buy a little bit more AltaGas, and cash is important to have right now. I'm sitting in about 35–40% in my equity income portfolio. The only one that is invested 10% in cash right now is the special opportunities where I keep the precious metals, and there I'm holding tight to everything I hold. That's a standalone portfolio for high net worth people that realize, okay, my advisor's not giving me any, but okay, here, set it up for me. And there it's got a solid track record of the companies we own, and they're all performing. One of them, no juniors are buying companies right now. One of the companies in the portfolio actually bought Pershing Gold, right, with cash. So I'm extremely happy with the way that portfolio is holding on and what's happening within the companies. And I'm very happy to be holding cash right now and wait for whatever happens, especially after the election. I think we're going to see a lot of change between here and year end.
So next Tuesday, that's the midterm elections. Obviously, there's a lot riding on that. We're going to get some sense overnight and then into the Wednesday trade. Remember after the presidential election, the futures in the morning, everything just went crazy. And they went crazy in the opposite direction. And then by the end of the trading day, we were in a different place.
Because I've always said this market is a facade, right? What's happening right now, they're showing up for the election. Trump has sold it to the Americans. Oh, the market's mine, the market's great. Well, I think he knows what's going to happen, right? Once he consolidates his power, he's able to kill the dollar, which is really what he needs to make America great again. You can't bring back the jobs when you're still competing at price differentials on the currency between Asia and North America. It won't happen. They need to kill the dollar.
I mean, it is never a dull night when you join us here on Market Call. Good to see you. Look forward to the next time.
Pleasure.
As
Thanks
always,
for having me.
please consult a qualified financial advisor before you make any investment decisions. We thank you for joining us, and we hope you watch more here tomorrow at BNN Bloomberg.